Rob, another deal in the pharma sector. Consolidation is still very active there. $15 billion deal this time, so it's quite a big one. Valeant, the Canadian pharma company, making a big acquisition and promising big cost savings here. What's the story?
Yeah, well, they better deliver big cost savings on this deal because they've really paid up for Salix. So they've paid something on the order of 40 times earnings in this deal. And when you pay up that much, you better be able to cut out big costs. And their target is really impressive. So they think they can take $500 million in research and development and corporate overhead costs out of this business. To give you a sense of how big a number that actually is, Salix guided for this year of non-GAAP research and development and corporate overhead costs of 560 million. So Valeant is talking about a savings target that is something like 90% of the non-GAAP expenses of the target company. Yeah,
that is enormous. How can you do that? And have they done this in the past?
Well, let's start by going into the past. They bought Medicis in late 2012. They bought Bausch & Lomb in 2013, both very large deals, also with aggressive savings targets, perhaps not as aggressive as the saving target for Salix, but aggressive all the same. And they say in the intervening years, they've actually exceeded those savings targets, and the company today is growing on an organic basis. Now, the numbers are always very hard to pick out in the case of any acquisition, as you know. So there's plenty of room for skeptics to say, well, they're cutting this corner or they're cutting that corner. That, of course, is what Allergan said when they rejected Valeant's entreaties, that the approach that was going to be taken to their company when they were acquired amounted to asset stripping, and they weren't having any part in it. So the answer to your question is open question.
Well, but is that a sustainable business model? Let's say they can buy this company and take out 90% of the costs. How long can they keep doing this? And does this company need to keep making acquisitions to keep going, given that it cuts costs out of everything it buys?
Well, there is, of course, the limiting factor of at some point you get large enough that the pool of targets that would move the needle for your company decreases. And but certainly there's a couple more years to run on the strategy before that happens. Another limit, do the target companies become prohibitively expensive? We may be getting to that limit already. And finally, do the results of the companies you've acquired slow down because you've underinvested in them, and eventually your organic growth slows down? That third question is the one a lot of critics are pointing to, but it hasn't happened yet.
Well, I guess it's worrying times for anyone who's at the target in this case. Rob, thanks very much.
Sure.